Hi, this is John Coumarianos with Real Investment Advice. Today we're going to talk about sequence of return risk. That sounds really complicated, but it isn't. It's simple and it's really important. Normally when we talk about returns in investing, we talk about compounded average annual returns. And that's really important for a lump sum investment. So if you invest a lump sum of money today and you achieve a 7% compounded average annual return for the next decade, you should double your money roughly. 7% typically doubles your money in 10 years. However, things are very different when money is moving into and out of a portfolio periodically, and we're not talking about a lump sum investment. Let's look at a couple of slides that will help us understand that. First of all, to set us up, let's just look at the returns, the compounded average annual returns of stocks and bonds since the year 2000 through 2017, so the past 18 years. Stocks represented by the S&P 500 have returned 5.4%. Bonds represented by the Bloomberg Barclays U.S. Aggregate Bond Index have returned 5.1%. So very close returns, just a little bit over 5% for both asset classes. You would think if someone retired in the year 2000 and they put all their assets either in stocks or in bonds or in some mixture of both, it really wouldn't make much of a difference. Their portfolios would look around the same today, assuming they each use the same distribution method. Not the case, though. Let's look at the next slide. These are three different portfolios. We constructed these portfolios using different allocations. One was all stocks. That's represented by the red line. And by the way, we use the so-called 4% retirement rule. That rule is that the retiree withdraws 4% off of their portfolio the first year. So in this case, they withdrew $20,000 from a $500,000 starting value. And then up the distribution, the $20,000 distribution in this case, by 4% each year thereafter. That's a famous rule in finance. There are different rules, but we thought we'd use the most famous one for this example. Again, let's look at the red line. Starting value of $500,000 in the year 2000, it's now down to just a little bit over $100,000. That's a very big decline. And again, that represents a full investment in the stock market. The reason is because we had a very big decline at the start of this period, in the year 2000, when the technology stocks took the whole stock market down. The technology bubble blew up, basically. So we had 50% decline roughly in the stock market from 2000 through 2002. You can see that decline here. And then, of course, we had another big decline in the financial crisis of 2008. The problem with this portfolio is it was volatile. It produced a 5.4% compounded average annual return, but when you're withdrawing money while the stock market's going down, that can be very bad for a portfolio. The blue line, by contrast, represents a full investment in the Vanguard Balanced Index Fund. That's just a fund that puts 60% of the assets in stocks, 40% in bonds, and holds or maintains that allocation at all times. Again, stocks and bonds didn't do very differently for the past 18 years, but bonds weren't as volatile. So that was much better used for the second portfolio. Sure, it declined here from 2000 through 2002, but not nearly as much as the pure stock portfolio. Declined again in 2008, but not as much. And overall, that investor has $400,000 or had $400,000 at the end of last year in their portfolio, starting from $500,000. So they're down about $100,000, but they've taken a lot of distributions over 18 years, and that's not such a bad position to be in. The third portfolio, represented by the green line, is a 30% stock, 70% bond portfolio, so the most conservative portfolio in this group. That portfolio has held up extremely well over the last 18 years, barely declined from 2000 through 2002, owing to its lower stock exposure, and it declined again in 2008. It fell just below $500,000, but really the decline wasn't that severe, and it has held up very well along the way, and that investor, that retiree, has their $500,000 still intact, having followed the 4% withdrawal rule. Again, the reason is because that portfolio just didn't impose the volatility on the investor. It didn't do any better on a compounded average annual return basis. In fact, it did worse because it had more bond exposure and bonds did slightly worse. What caused the portfolio to hold up is that it was less volatile, and so it could withstand withdrawals or distributions much more easily. Sequence of returns is so important because big declines while you're withdrawing money don't give your portfolio a chance to recover. And that's why it's important to have a stabilizing asset in your portfolio like bonds, even if bonds might not perform as well on a compounded average annual return basis. When the stock market goes down a lot, if you have a lot of money exposed to it while you're withdrawing money, that can be catastrophic for a portfolio, and that's what the red line here shows. So retirees have to be worried not only about what their average compounded annual returns might be, but also what their prospective volatility is. Please check out my article on the website, Real Investment Advice. This is John Coumarianos signing off. Thanks for watching.